A very good morning. Just wanted to check if I am audible and visible.
Yes, sir, you are audible.
Yes, thank you. Yes. Should I start or do I have to wait for a few minutes? Okay, yes. Good morning, everyone. So, I welcome you to the first session of your program for financial analyst. I am Dr. Sai Kulkarni, and I will be taking basics of finance and finance specialization for you all. Okay, so I hope we can start.
Yes.
All right, sure. Yes. So let me give you a little bit of introduction about myself. I am Dr. Sai Kulkarni. I am BBA in finance, MBA in finance, NET qualified, and PhD in financial management. I have more than 15 years of teaching experience in financial management for graduate and postgraduate programs such as BBA, MBA, etc. So I'll be taking introduction to financial markets today. Now, if I want to just take a short round of introduction, so if you can tell me your name and what do you do? Yes, we can start with Aman.
Yeah, good morning. So
One.
this,
Yeah.
basically, I'm working as a business analyst. I have 4 years of experience, but
Okay.
it is totally into e-commerce domain.
Okay.
So I've been giving interviews like in finance and insurance domain, but due to domain knowledge, I was not
Hmm.
able to clarify the final round. So
Okay.
this is the main reason I'm enrolled in this course
All
and
right.
looking forward to learn finance and insurance domain in a better.
Okay. Yes. Okay.
Uh,
So
so the selection, instead,
yes.
yeah, no issue.
Yes. Akshat.
Yeah, so this side Akshat, I am working. I have 4 years experience in the. I am working as an analyst. I have 4 years experience in the sustainability domain. So, and I have
Okay.
done my PGDM in finance also. So, after the 4 years of my finance knowledge is something I don't because the terminologies of financial. That's why I joining this particular course.
Okay, yes. Okay, hello Ibrahim. So you are working in Motilal Oswal as a dealer. All right, fine. Yes, what about the others?
Hi, this is Lakshmi.
Yeah,
I have completed my PG in banking and insurance. So
okay,
currently, I'm working with Accenture as an R2R analyst. So
okay,
for my to grow in ahead in my career, I thought finance analyst and this entire program will help me to grow. So I have enrolled this course. Thanks,
okay,
Sally. Yeah.
okay. Hello.
Hello, Kalpana this side. Uh,
Yes,
yes, good morning. Morning,
good.
everyone. Uh, yeah, I'm basically by profession as a teacher. Now I
Yes,
just find that my interest is in finance, so I want to upgrade myself and shift to corporate. That's why I have
okay.
joined this course. Thank,
Yes,
thank you.
which subject are you teaching, Kalpana?
Actually, earlier I was hello,
Yeah, yeah,
hello. Yeah.
yeah, yeah. Go ahead, go ahead.
Actually, earlier I was teaching in school.
Okay,
And past 3 years I was teaching in degree college as accounts is my main subject.
okay, great.
So I thought
So
I should go in. Yeah.
yes. So, hello Shivam. So, Shivam is a QA test engineer and he's completing MBA in finance. All right. Yes. Uh, Shikhar, hello. Yeah, no, not an issue. So, you have a specialization in finance and you're currently working as an associate. Okay, great. Yes. So, according to the demographics of this meeting today, I presume everybody of you has a basic knowledge of finance. So, our financial industry overview or the introduction to financial markets is something that you would have a fair idea about. Okay. So, maybe we can have a more of an interactive discussion rather than me just going on because today what we are going to learn today and tomorrow are the basics of finance that you need to know for being a financial analyst. Of course, those of who you don't know, I'm here to explain all your doubts. All right. So this is introduction to financial markets. And I presume there are many people from banking and insurance sector. So if you wish to add, you can surely do so. Yes. So with this, let me begin with our session. Yes. So what exactly is a financial system? I hope the slide is visible properly.
Yes.
Yeah. Okay. So what exactly is financial system? Here, when we understand about money, so money is very important. Yes, all of us are here to earn money, to increase money, to grow money. Yes, but we need to understand one thing, that we need to finally mobilize money. When I say I earn something or I spend something or I invest something, what am I doing primarily is to mobilize money. Yes. So a financial system is the medium through which you mobilize your savings in the form of money and monetary assets and invest them. There are some people who require money, yes, who want money for their maybe business, yes, and there are some people who are interested in investing their money. So there are some people who need money, and there are some people who can give money. Okay. So this whole movement of money is through the financial system. Every country has their own financial system, organized or unorganized as well. All right. So the functions of the financial system that we can see is to provide liquidity. It helps in mobilization of savings. It's a size transformation function and a maturity transformation. So you grow in your money in size, or you keep your money locked for a period of time where it can be invested and where you can get a higher amount at the end of the day. So firstly, your savings are getting utilized. Money that is kept in a lake will, or it is which is kept in a bottle, will get bad after some point of time. So just like water, money needs to be kept flowing. Always it needs to be kept flowing. Also, your money just sitting in one place is not going to give you a return. It will give you liquidity, but it will not give you a return. So if you invest this money in some kind of instrument, then you are going to get a slightly higher amount than what you have today. So your money is working for you even when you are not working with that money. So you are pursuing your own profession, and when you invest, this money is doing work on their own to give you a higher return. Yes, maturity transformation happens when you invest money and you get it back. Sometimes you wish that you don't get it back. Sometimes you want to get it back for a limited time period. So everyone has a financial goal, and if we take part in this financial system, it helps us to reach our financial goals. So this is what an exact financial system is. And today's session is going to all revolve all around the financial system. All right. So let's go ahead. So these are a few kinds of financial assets. So when we say that the financial system consists of what? The financial system consists of mobilization of money through these assets. Now, there are some assets that are called as marketable assets, and there are some assets which are your non-marketable assets. So your marketable assets are those who have a medium of exchange, who have a platform for exchange. It can be, in common terms, it can be called as a stock market or a commodity market or an foreign exchange market or any sorts of market. So there is a full platform available for trading in these financial assets as well. Those are called as your marketable assets. Now, there are some assets which are non-marketable as well. Non-marketable assets stay with only one entity at a time. So if you invest with one entity, it stays with that entity, grows over a period of time, and you get money from that entity as well. Okay. So a few marketable assets are shares. Shares are basically equity shares. Then there are government securities which are tradable in markets. Then there are bonds. Then you have mutual funds, UTI units which are tradable. Bearer debentures are also tradable. A few non-marketable assets include your bank deposit, what we very commonly call as time deposit or fixed deposit, your provident fund, LIC schemes, the other corporate company deposits, or post office certificates. Okay, so these are a few financial assets through which we invest. Of course, this list is not exhaustive because as the financial system has grown in scope and in depth, there are many more financial assets that have been developed. So these are what we call as basic financial assets. There are many more ways and means by which you can now invest in the market. The term for options and futures has become very common, right? It is a derivative instrument, not considered to be a proper financial asset because the value of the asset is derived from any one of these or other kind of assets. So these are a few financial assets. Then, if we talk about financial markets, so which is the place where financial assets are traded? The place is called as the financial market. Now we have two kinds of financial markets. One, which is the organized market, and the other, which is the unorganized market. So let me come quickly first through the unorganized market. Now the unorganized market has no legal standing. It means that if you have some discrepancy as a participant in the unorganized market, you get absolutely no kind of legal protection. Now, before the organized market developed, the entire economy used to be run under the unorganized market. When there was absence of law, any legality, let's say I would talk about a period which was earlier than 1930s, because in 1930s what came up was the RBI. So prior to the 1930s, the entire economy used to be run by the unorganized market. Now, what all is a part of your unorganized market? Firstly, you have money lenders, what we usually used to call as saukars or zamindars or all such things. Then there are indigenous bankers who these indigenous bankers used to lend money, they used to accept deposits, they used to decide the interest rate on their own. So there was no kind of parameter or there was no kind of way in which these people would be controlled. Then there used to be chit funds wherein you invest. So it was like the most primitive form of an SIP. The way you contribute every month to an SIP, systematic investment plan, the same way these chit funds used to be done. And turn by turn, every member used to get this. So what are the amount of time that you remain invested in that chit fund used to get that much of interest. Also, there were options that you can borrow through these chit funds and you will be charged with a rate of interest. So these were the entities in the unorganized market. Now the times have come such that the importance of the unorganized market has completely diminished. Okay. So the reason is that people have become more and more aware. And since unorganized market does not have a legal standing, I don't say that it is non-existent. I still say that it is existent. But because of the awareness of finance, the awareness of financial inclusion, the unorganized market has started to lose its steam, and many people are being included in the organized market. Any entity who becomes a part of the organized financial system is said to be financially included, or they are said to be having financial inclusiveness, right? So let me come on to the organized market. The organized market is made up of two sections. One is the capital market and the other is the money market. The basic difference between capital market and money market is that capital market is for financial assets which are long term in nature. Okay. Then the money market is a market for financial assets which are short term in nature. So the market classification is on the basis of the maturity date of the financial asset in which you are trading in. Of course, there is no inclusion of those non-marketable assets here. So financial markets are only for the marketable financial assets, and they are not there for the non-marketable financial assets. So you cannot include a bank FD or a post office FD to become a part of the financial market, because basically their nature is such that these are non-tradable. So whatever financial asset is tradable, that is included in the financial markets. Now, what is an organized market? Organized market is where the market for financial assets is regulated by some regulator. It comes under some kind of government purview. There are various institutions that are present in the financial system, such as the RBI, who is a regulator of banks and the money market. Then we have Securities Exchange Board of India, which is a regulator of the capital market. We also have the IRDA, which is a regulator of the insurance market. There is another institution called as the PFRDA, which is a regulator of the pension funds in India. So basically the NPS. So there are some regulators which have a control on these markets. Now, why should there be a control on these markets? The investor at all times should be protected, is what the government thinks. People are investing their hard-earned money into these markets. So when these markets function as they are, there are chances that the entities in the market take benefit of the uninformed investors. Okay, so uninformed uninformed investors should not be duped, and that is the reason why there is some entity who is regulated, or who is a regulator. So the organized market does have a legal standing. If you have any grievance, if you have any problem, there are entities to which who can resort to you. So the organized market, coming back to our discussion, the organized market is made up of two sections. One is the capital market and the other is the money market. Now, capital market is a market for long-term financial assets, and money market is the market for short-term financial assets. Now, how do you classify these financial assets into long-term and short-term? Now, these financial assets are classified as long-term on the number of years of their maturity. So usually financial assets which mature less than a year are called as money market instruments. So this is less than 1 year. Okay. So money market has instruments which are traded, which are less than a year. Just give me a minute. Okay, hello Jatin, you can get in touch with the administrative team and you can find out whether this recording is available. The meeting is being recorded. The availability of lectures will be told by them. Thank you. So, sorry about that. Coming back, money market is for instruments which have a maturity value of less than a year, and capital market is for instruments which have a maturity of greater than a year. Hmm? So the long term are said anything which is greater than a year, and that comes under capital markets. Short term is where it is less than a year. Hmm? So this is the classification. So these two different kinds of instruments have two different kinds of uh, these two different kinds of markets have different kinds of instruments. Sometimes some instruments may be applicable in both. Okay, so such instruments are also there which can find a place in the money market at that or also in the capital market. However, the nature of these instruments are different. For example, mutual funds. There are mutual funds which are long term as well as short term as well. Okay, so mutual funds which are for a short period of time are traded in the money market, and mutual funds, which are for a long period of time, are traded in the capital market. I hope it's clear. I hope the pace is fine. Yes. And I hope I'm not
Yes.
boring you.
No, no.
Okay, fine. Yeah. So see, a few basics, I know most of you know it, but a few basics need to be done in depth so that you are able to use that in your financial analytics. Hmm? Yes. So we'll go ahead with capital markets. Capital markets have three different kind of markets. One is an industrial securities market, which we commonly call as shares. Okay, which we commonly also call as shares. Shares are markets, shares are instruments which have ownership of the company. So when we trade in these shares, they are going to be traded in the capital market. The reason is that though we can buy a share today and we can sell it tomorrow, originally share is an instrument. Share is a financial security. There are different names for this. Okay, so even though share is an instrument or a financial security which as an investor you can buy today and sell tomorrow, so should it come into the money market? No. Originally share is being issued by a company, and it is being issued to a shareholder. Now, there is no maturity value for this share, and with the company, you can trade this share. So the share can have different holders. They can have different owners. But originally, the share stays with the organization till the organization lasts. There might be a case that the organization lasts for 1 year, but still, inherently, the share lasts for a lifetime of the business. Now, that lifetime of the business could be 10 days to infinity. There have been companies whose shares have been issued for more than 150 years now. So, till the time the company is there, the share is an instrument which is there. That is why it is a long term security. And the market for these long term securities or shares will be your industrial securities market. Now, this share market is also divided into two categories, which is the primary market and the secondary market. So, the time when a company issues shares for the first time, or the company issues share subsequently to shareholders, it will be done in the primary market. So people who know these concepts In what way shares are issued to the public? Can you tell me the ways in which shares are issued to the public?
I IPO.
Correct. IPO, and there are several ways in which shares are issued to the public. So yes, one is the IPO, or the initial public offering, where a company, a private limited company, issues shares to the public for the first time in their lifetime. So that is when a company becomes a public limited company from a private limited company. So from a closely held company, when a company allows the entire public to become their owners, that is called as an IPO. Other than IPO, what are the ways and means of issuing shares, fresh shares? I think Ibrahim can answer. You could answer on chat as well, not an issue. Yes. Bonus, NFO, good. NFO is far more for mutual funds. Yes, bonus shares. Now, bonus shares are ways where the existing shareholder get shares for free. So the company is issuing shares, but without any cost. Yes. So along with IPO, you have an FPO. Yes. So FPO is split. Yes. So FPO is, I will talk about splits after I explain this. All right. So along with an IPO is when you are issuing shares for the first time. But later on also the company requires funds, and they can raise the funds from public. It's not compulsory that ek bar ho gaya bas ho gaya. You can raise funds subsequently so many times after an IPO is done. That is called as an FPO, which is a follow on public offer. Follow on public offer is the second, third, fourth, fifth, 10th, 20th, 100th time that a company might feel that they can raise money from public. So we have one, which is IPO. The second, which is a follow on public offer. The third one is what we call as a bonus share issue. Now, an IPO and a follow on public offer is where, yes, so whenever VC or private equity gets liquidated, then they offer their shares to limited partner. Yes. Hmm? So this is an IPO or an FPO. The next one is your bonus shares, where the existing company issues shares free of cost to their existing shareholders. Okay. Next kind of way is ESOP. Yes. So ESOP is where your employees, as a token of appreciation, are given shares sometimes at free of cost, or they are given at a cost which is lesser than the average market price. So we have IPO, we have FPO, we have bonus shares, we have ESOPs. Another way is what we call as rights shares. So if a company is in requirement of lesser amount of money and they don't want to go public, because that takes, of course, a lot of time, effort, permissions, and of course it takes money to raise money as well. So if they want to do it in a smaller way, if the quantum of money required is lesser, what they can have is also a rights issue. Now a rights issue is an offer made to existing shareholders for the purchase of new shares. Okay. So that is a rights issue. Now, when we talk about split, split is a way, yes, mergers and acquisition process that happens when one company buys shares of another company. But right now, at present, I am talking about the primary market. Mergers and acquisition shares are bought and they are already existing in the market. It is change of bulk ownership. It is no issuance of new shares, but the transfer of existing shares from one majority stakeholder or shareholder to another majority stakeholder who wants to take that stake. So I hope that that makes it clear, Shikhar. Right. So even when you talk about venture capital, it is shares that have been issued for the first time. Now, I will talk a little bit since we are on this discussion. I will talk a little bit about private placement of shares, which is again a primary market function. Yes. So private placement of shares is when you don't want to make a halla gulla about no, I'm issuing shares, and always it's not necessary that the public will that the public will buy your shares. If I want to keep my share issuing process a little hush hush, or I don't want to have that whole pain of giving advertisement in the papers and taking applications and processing applications, I can find one or two tagda investor. Hmm? Now that investor can be a venture capital firm, or it can be a private equity partner to whom I will issue the shares as a company in bulk. So I need not go to the public. So when I'm talking about primary market, I could have an IPO, I could have an FPO, I could have I could have a rights issue. I can have a bonus issue. Of course, bonus issue does not give you money, but it saves on dividends. Okay, so we'll talk about that when we come to shares in today's lecture, right? Or we can have it through private placement of shares where we don't need to go to the public for raising money, but we can go to a few limited number of investors who will make bulk investments. So there are a few private equity firms who would invest in your business. There are a few venture capital firms who will invest in good upcoming but however risky investment because they have a little bit control on the management of the business as well. You can have several entities. Let's say, for example, LIC has a lot of money. We always keep giving premiums to LIC. So, LIC, what does it do with this money? It pays out the risky claims, but not all money, all people don't die in 1 year, to be very honest. Yes. So, what about the remaining money that LIC has? LIC can invest in bulk in a company, right? So these are the ways and means by which you can make a fresh issue of shares. Okay. So the primary market is a market where shares are issued afresh. Okay. Now coming to the question of a stock split. Okay. So I would like to clarify that since Ibrahim has put up this uh, way. So stock split is when you split an existing share. So in that, new shares are not issued, but an existing share is cut down into several parts. Okay. So since this share is cut down into several parts, a fresh issue of the number of shares is done, but the value of those shares remains the same. So if I have a share who has a face value of rupees 10 and I cut these down into 10 shares of face value rupees 1, that existing share is transformed into 10 shares. So one existing share of 10 rupees each is transformed into 10 shares of 1 rupee each. Okay. So this is the way in which a stock split happens. The number of shares increases, but the old share is transformed into a new share. So we can't exactly say that it is a primary market function because the existing share is there and it just changes faces. So I hope that clears your doubt, Ibrahim. Yes? Okay, great. Yes. So now what happens? Shares तो issue हो गए, पब्लिक ने भी भर भर के पैसा दिया, भर भर के शेयर्स लिए. What happens next? Some people choose to keep these shares with them for a lifetime. Hmm? But some people want to trade these shares. So let's say that let's take a very easy model. Okay. So let's take the fact that there are just two shares in the economy. Now, there are two companies and there are two shares. Now, a person is tired with holding the shares. They want to get out of that investment. Reason number one, yeah, I want money right now and I want to get out of that investment. Now, as a shareholder, there is no two-way transfer between company and shareholder. So company can issue shares to the shareholder, but the shareholder cannot go back to the company to say, या भाई ये ले लो, मैं बोर हो गए, मैं बोर हो गई, ये ले लो, तुम्हारे शेयर्स वापस ले लो और मेरे पैसे वापस दे दो. That cannot happen. Of course, there are exit options and all that when we talk about venture capital. That's a different story altogether. But then shareholder can't say, यार बस हो गया, बोर हो गया तुम्हारी कंपनी में इन्वेस्ट करके, अभी ये आपका शेयर्स ले लो और मुझे मेरा पैसा वापस दो. What will company say? एक बार शेयर दिया मतलब लाइफ टाइम के लिए दिया, तुमको बाहर जो करना है वो करो, हमारे पास मत आओ. सो एक बार जो कंपनी ने शेयर दे दिया, सो दे दिया. Now, where does the shareholder go? Shareholder to needs money. So where will the shareholder go? The shareholder will go to the secondary market. The shareholder will go to a market. Primary market, there is just one-way transaction. In the secondary market, there are many such people like these shareholders who want to sell their shares. Now, using the basic market principles of demand and supply, let's say there is a demand for a share in the market and its supply is limited. So obviously, the share price of that will increase. If there is more buying of that share than selling of that share, then the share price will increase. If there is more selling of that share than buying of that share, the share price will fall down. So there is this market established where such investors can come and sell the shares. Now, there is someone, a person, let's say, who does not have any shares, but always feels, यार भाई उस कंपनी का शेयर होता तो बहुत अच्छा होता, मुझे उस कंपनी का शेयर होल्डर बनना है. So I would say to that person, यार मेरे पास शेयर्स है, तू ले ले. So फुकट में नहीं लेना है, पैसे दे दे. मैंने 20 रुपए को लिया था, अब ये कंपनी अच्छी चल रही है, इसीलिए मैं वही शेयर्स 40 रुपए को बेच रही हूँ. सो द अदर इन्वेस्टर सेज ठीक है, आगे जाके ये कंपनी और अच्छा करेगी तो मैं 40 रुपए देता हूँ. तो 20 रुपए का जो मैंने शेयर इन्वेस्ट किया था वो 40 रुपए में मैंने बेचा. सो मी एज अ शेयर होल्डर, सिंस आई वॉज बोर्ड or I did not want to invest in that company, I sold that share to someone else. That someone else, Mr. A, B, C, D, ABC, whoever, wanted to invest in that company. But अभी शेयर इशू तो आ नहीं रहा है, तो इन्वेस्ट कैसे करें? तो सेकेंडरी मार्केट से उस कंपनी का शेयर खरीद लिया. You buy that share, but from the secondary market, because there is no way at this point of time that the company is opening the primary market. Share issue is not happening, an IPO is not happening, an FPO is not happening. Even whenever there is a rights issue or bonus share, the existing shareholders will get, new shareholders cannot be added. So the share takes a buying and selling option, and the ownership of the share is transferred from the seller to the buyer of the share. And all these transactions happen in the secondary market. All stock exchanges, commodity exchanges are a part of secondary market. Could you tell me a few names of stock exchanges in India?
BSc, MS.
NSE, BSc.
BSc, NSE. There are some more also.
State Stock Exchange, Kolkata,
Yes.
Ahmedabad.
Correct. So there are these national level stock exchanges, which are primarily BSE and NSE, and there are regional stock exchanges as well. We don't usually know about regional stock exchanges, but there are close to about 20 regional stock exchanges where share trading happens. Ahmedabad and Kolkata Stock Exchange are relatively larger in size, but there are other kinds of regional stock exchanges as well. Usually, people, they have this notion that Bombay Stock Exchange will be in Mumbai and the National Stock Exchange will be in Delhi. Correction. Both are in Mumbai because Mumbai is the financial capital of the world. Just, I mean, small trivia which everybody actually knows. Huh? So, these are exchanges where shares are traded. There are other securities also which are traded that we will talk here. Okay. So the marketplace is your stock exchange. A fresh issue which happens by the main company issuing shares, that would be in the primary market, and the trading of those exact shares would be in the secondary market. Now, this transfer from primary market to secondary market happens on a specific day, which is called as the listing day. So a company is issuing shares for the first time. Someone said IPO. So the company issues shares, but the day when it allows trading is called as a listing day. It is a very nice function that the owners of the company, they ring a bell or a gong which states that from today the shares will be traded in the market. So there is a shift from the primary market to the secondary market on the listing day. That's when the company's shares are up for trading, are up for buying and selling in the stock exchanges. So this is for shares or equity shares. There are other kinds of securities or financial assets which we will talk about. So the first one is the government securities market. The government also needs money, and the government may be requiring money for the short term or the long term. So when it is for the short term, it will come under money market. When it is under long term, it will come under capital market. So let's take for examples. Do you know a financial instrument called as the RBI bonds?
Like treasury bonds.
Hmm?
Like treasury bonds.
Hmm? Yes. Treasury bonds are there, which have a maturity of, let's say, around 10 years, 20 years. We also sometimes call them as GSECs. Government securities? Yes. So do investors invest in these government bonds? Yes. Can a normal investor invest in these bonds?
Yes.
People like you and me? Yes, we can invest in these bonds. Plus, they have a feature of tradability. Now, yes, for safer return, we invest in government bonds because the government is the biggest assurance that we can get. So the money or the interest that you get on these government bonds is safe and secure, because companies may go insolvent very fast. Governments will never go, or very rarely will the government default. Okay, government is something of an assurance. Company, maybe today it is there, tomorrow it may have filed for bankruptcy. or day after tomorrow it might be taken over by some other company. Yes, so such kind of things do happen with companies. So government securities are very safe instruments. So primarily the government also needs money for short term as well as long term. So when the government needs money for long term, they issue government securities. Okay, and these government securities again have a primary market and a secondary market. Primary market is when the government issues them, that is a part of the primary market. And secondary market is when these government securities are traded. It is also called as the debt market. Okay, it will also be called as the debt market. So government securities is also sometimes called as a debt market. Okay, so what this is your equity market and this is your debt market. There too, you have a primary market and a secondary market. Government securities are tradable. Now, the trading though is not very extensive, but still there is trading that is happening in government securities. Mostly banks and financial institutions are a part of this trading rather than individual investors. You will find a majority of individual investors in the equity market, but you will not find individual retail investors in the debt market, right? Then what you have is a long-term loans market. So you can have term loans market, you can have a market for mortgages, and you can have a market for financial guarantees. Now, technically speaking, there are instruments which also take part in trading of these financial securities, right? But this trading is not very prevalent in India as compared to the other economies such as USA, etc. There is a method called as securitization where instruments are made out of these as well, and then they are traded in the market. Okay, so there is this uh, uh, arrangement where the risk from the bank is transferred to the investor in exchange of a return. That is called as securitization. Hmm? But securitization, even though it is prevalent in India, but it does not find a huge customer base. And basically, it is a very risky thing for a bank to transfer its risk to other people, and those other people take the risk. In case of default of a loan, the entire chain faces losses. Basically, that is what led to the global meltdown of 2008. So, securitization is a very risky, very, very, very risky thing. But then, yes, it does have a very strong primary market. So you have a term loan market, which will have a primary market. You will have a market for mortgages. Mortgages is when you keep some property for a mortgage and you get a loan against it. The second one is a term loan where it can be a security or a non-security, something like a home loan or a business loan or other kinds of loans where you are buying some asset, you're creating some asset, and you need money from that for that, either for business or for domestic purposes. Mortgage is when you have an existing asset and you are taking loan on the basis of that asset. Okay, so term loan market and market for mortgages are two different things. Term loans are usually taken for creation of your assets. In business parlance, we call it as term loans. For domestic people, it can be a home loan or a car loan or some equipment loan. Hmm? Mortgages means you have an asset which already exists in your financial portfolio and you are taking loans against it. So I took a home loan, I repaid that home loan, and then I have a house which is now my property. Now, later on, when that term loan is finished, I'm in need of some money, so I mortgage the house that I bought through home loan, and that becomes a market for mortgages. There is also a market for financial guarantee when a bank or a financial institution gives the other party the guarantee that your customer will pay. If the customer does not pay, the bank or the financial institution will pay. This is a financial guarantee which is usually given for trade purposes. So when you have to pay someone some amount of money, but the other person is not sure because that money is not coming upfront, okay, and money is going to be paid at a later date, and it's a huge sum of money. So the person who to whom money is receivable in the future asks for this kind of financial guarantee. So a bank or a financial institution says कि यार ये मेरा customer है, अगर इसने नहीं भरा तो मैं भरूँ. Okay, so that is a market for financial guarantee. Clear about capital markets? Any doubts you have that you want to discuss for capital markets? Yes. Okay, great. So capital markets we have understood. Now let us go on to money markets. Money markets is a market for short-term securities. Any security whose life itself is less than 1 year will be a money market instrument. Okay. Now, can you just tell me from experience, all of you are working professionals, which one would be bigger as a market in terms of trade and volume? Which market would be a bigger market, the capital market or the money market? Yes, the money market is a bigger market. Hmm? Now, though these instruments, okay, though these instruments are for a very short term while, the volume and the scale of money market is much, much larger than the capital market, because the participants in the money market are the banks and financial institutions. There is very limited space for what we call as the retail investor. Okay. So very limited space for the retail investor in the money market. Okay. So very less space. The major participants in the money markets are banks, large corporates, then financial institutions, and the government itself. Okay. Now let's first understand the money market. Now there is no scope for a primary market and a secondary market, because the time period for such security is very limited. Of course, there is a primary and a secondary market in existence, but their existence is not well classified like we have for the capital markets. Okay, so the primary market itself becomes the secondary market. Hmm? Now let us first understand this. What is a call money market? A call money market is where funds are exchanged and transferred for an interest from one financial institution to the other just on the basis of a phone call or an email. So for example, let's say Bank of Baroda is in need of money. It's all FDs are maturing, but the interest that they are going to receive on the loan or the repayments of the loan are not enough. So they need money till month end. Today is what? 17th, and they need money from the period of 17th of May to 31st of May. Post 31st of May, they are going to receive the money. So Bank of Baroda will call Bank of India that can you loan me money for 10-15 days. Bank of India quotes an interest rate to which the Bank of Baroda accepts. Now, this interest rate, is actually calculated on a daily basis, right? So this is calculated sometimes on a daily or a weekly basis as well. Ki for a day, this much interest rate, 0.5% interest rate per day. So by the end of the time you get, after 15 days, you get our 7% interest rate. So Bank of India both agree to this. Maybe there is a phone call or an email regarding this, and then money is transferred from Bank of India to Bank of Baroda. Bank of Baroda on the 31st pays this money back. This is called as the call money market. Now, the call money market is very, very liquid with no underlying security. What if Bank of Baroda doesn't pay? But then we have to understand that both entities, Bank of India as well as Bank of Baroda, are very well established entities. Okay, so them defaulting is something which is very rare. Okay, there might be a day or two of movement, but when recognized and established financial institutions, they ask for money from the market, it is usually very, very credible, because they also have to keep their promise, correct? So that is a call money market, where you just simply call upon, one entity calls upon the other entity in the money market, loans the money for a short period of time. Usually these are loans which range from 15 days to about 2 to 3 months, not more than that, right? So this one's a call money market. The next is a commercial bill market. Okay, a commercial bill is also called as an instrument, which is called as a commercial paper. Okay, in common terms we call it as CP market. Now, a CP market is where corporates are involved. Okay, so there are two things. One is the commercial bill market, which I'll be also talking about banks, but I felt that commercial paper is not mentioned here. So one more instrument in the money market is a commercial paper. Now, what do you feel? Do companies need money for short term? Will they need money for short term? Yes, they will require money for short term. So is it advisable that they raise this money through shares? Not at all. Yes, because the process of share issue takes a lot of time, and plus it doesn't work well on the capital structure of the business. What is capital structure? We will come to when we are discussing later on. Yes, but it does require money for a short time. Now, a company has several options. Either it can go to a bank, take a working capital loan, and that settles. Okay, but what if the working capital limits are exhausted? Possible. Yes. So what they do is, just like we have shares on the capital market end, we have something called as commercial papers, which are uh, promissory notes issued by the company that give us some money. We will pay you 4% interest, and this money we require for anywhere between 3 months to 1 year. So, a lot of financial institutions, if they want to make a short term investment and earn money, they will buy these commercial papers. The commercial papers are a money market form of shares. They have a specific denomination. So, they are issued in multiples of 500. So 500 रुपए का एक commercial paper, maybe an NBFC, a non-banking finance institution such as let's say Capri Global. It's a financial institution. It wants to invest somewhere because they have been collecting money through deposits, giving out loans, but they also have still some money left. So they will invest in commercial papers. Quick हो जाएगा transaction, ज्यादा burden भी नहीं आएगा. Company है, अच्छी है, so पैसा डुबाएगी नहीं, right? So that is called as the commercial paper, which is an instrument which is issued by a company, a corporate organization, for the entities in the money market. The entities in the money market invest in this. Now, the beauty of this is that if a financial institution invests in a commercial paper and then wants to get rid of their investments, this commercial paper is tradable. So there is a primary market for a commercial paper where the company issues to a financial institution. There is a secondary market where one financial institution sells this commercial paper to another financial institution. Yes, so commercial papers are tradable. Now, what if banks require money and they don't want to make use of the call money market? Banks have another way in which they can invest. Okay, and that is called as certificate of deposit. Okay, so certificate of deposit is an instrument which is issued by the banks. All right, so the nature of a certificate deposit is exactly similar to a commercial paper. Only thing is that banks issue certificate of deposits and corporates issue commercial papers. Okay, and again, certificate of deposits are not your FDs. Okay, they are obviously they are not your FDs. They are again money market instruments which are tradable, right? And then it is again for a very short period of time. Let's say somewhere around 2 months to 6 months, and certificate of deposits are also tradable. All right. So this is call money market, commercial papers, certificate of deposit. The next comes commercial bills, or which we commonly call as the bills of exchange. Okay. So these are your bills of exchange where bills are being discounted. Now there are large scale credit transactions in the market. Yes, there can be high level of credit transactions in the market. Let's say 200 crores or 250 crores or 1000 crores. Yes, there are businesses which range in that manner. Now, let's say if company A has sold goods to company B and company B needs to pay 250 crores to company A, but company B right now is not in a position to pay. So what happens is company B draws a bill of exchange on company A stating that it's a promise that I will pay after 3 months, to which A accepts because that's the condition of trade, right? A accepts wholeheartedly. Yes. So that is the transaction. Now in between, company A requires a lot of money and they say that yes, we have a promise of a receipt of 250 crores, but that maturity date is after 2 months. So what should I do? The way in which company A can raise the money is to go to a bank or a financial institution or a specialized financial institution if it is an international trade, and then they get this bill discounted from a bank or a financial institution. Okay, so they will get this trade which is discounted from a bank or a financial institution. That is called as the commercial bill market. Now, there are several entities in this nature as well who are called as factoring agents. But factoring agents do the work for a long time. Sometimes, when a company has a lot of debtors, a factoring agent buys those debtors and all the payments happen through the factor. Okay. So all these entities are present in the commercial bill market. Again, this bill should not be more than 1 year. Usually bills don't range for more than 180 days or so. Okay. Understood? Any doubts here? Yes, any doubts? I hope not. All right. Yes. Now let's go to the treasury bill market. Again, like I said, government is in need of money. Loads and loads of money. देश चलाना है भाई, इंडिया जैसा देश चलाना है, which has the largest population in the world. Yes. So अगर देश चलाना है तो पैसा लगेगा. इतना तो टैक्स हम भरते नहीं कि पूरा पैसा पूरा कंट्री टैक्स से चलेगा. So what does the government do? If it requires funds for the long term, you have the government securities. But if the government requires money for the short term, okay, if it requires money for the short term, right, then there is a way in which we can issue, and that is called as the treasury bill market. Okay, so the treasury bill market is a market for an instrument which is called as the treasury bill. Now, treasury bill is something which is issued by the government who have maturity dates like 91 days, 180 days, and 360 days. So you invest in that treasury bill for 90 days and you get your money back. Yes, you invest in that treasury bill for 180 days. After that, you get your money back. You invest in that treasury bill for 360 days and you get your money back. Right? So, a treasury bill is issued by the government through the help of RBI. Okay? And then it can be issued. Now, the thing is that there is a huge structure and a process. So, a normal investor at present is allowed, but then a normal investor might not go much for a treasury bill. Now, what happens if that, for example, if the treasury bill is for 100 rupees, it is usually issued for 96 rupees. So what you do is you get a treasury bill for 100 rupees, but you are paying 96 rupees for that. So you pay 96 rupees to the government for a treasury bill of 100. When the treasury bill matures, you get 100 rupees back. 4 रुपए आपका इंटरेस्ट समझ लो, फायदा समझ लो, रेट ऑफ रिटर्न समझ लो. Okay, so this is how treasury bills are issued. They are issued at a discount and they are repaid at maturity. Okay, so this is how treasury bills function. So this is a market for treasury bills. The largest players in the treasury bill market are banks. The reason is that banks have to maintain some deposits with the RBI. One is that they have to maintain a cash deposit, and the other is that they have to give RBI money by purchasing some government securities. So that is a compulsion that banks have to follow, and they have to maintain a certain percentage of deposits either in the form of cash or in the form of government securities and treasury bills with the RBI. So banks use this treasury bills and government securities as a way and mean to satisfy this ratio. These ratios are called as cash reserve ratio and statutory liquidity ratio. People who may have a basic knowledge of economics will be acquainted with this. The CRR and the SLR are two ratios in which the RBI has to, the RBI mandates banks to maintain some reserves with the RBI either in the form of cash or in the form of instruments. So treasury bills are used mostly for that, to maintain your statutory liquidity ratio. And the next format in the short term is, or the money market, is the short term loan market. There are several kinds of loans, such as a bank overdraft or a cash credit or a working capital loan, which any entity can acquire from the bank or the financial institution. Again, most of the times this is non-tradable. Okay. but they can be traded in certain cases as well. Okay, so this in all, this huge part of discussion in all is our financial markets. Just to give you a quick recap, you have two sections of the financial market, the organized and the unorganized market. Then you have a capital market, a market for long-term securities, and you have a money market, a market for short-term securities. In the capital market, you have an industrial securities market, which we commonly call as shares. You have a government securities market for government, and you have a loan market. Most instruments have a primary market and a secondary market. Primary market is where fresh securities are issued, and secondary market is where these fresh securities are traded. Then you have the money market. A few instruments in the money market are call money market, a commercial bill market, a commercial paper market, a certificate of deposit, a treasury bill market, and a short term loan market. You also have the unorganized market, which is not mandated by any kind of law, and they are basically your pawn traders, money lenders, indigenous bankers, chit funds, etc. I hope this is clear. Should we now move on to the next topic? Yes. Okay. So I did not though explain much in detail because most of you have a fair idea, but syllabus demands and syllabus will deliver. All right. So let's go ahead. Yes. So before we go ahead, I think so we've been discussing, can we have a 5 minutes break? Yes. So right now it is 9:25. We will come back exactly at 9:30. Is that okay? Yeah. So we come back exactly at let's try and make it at 9:30. Have a glass of water. Go freshen yourself. And okay, fine. We'll come back at 9:35. All right. Yeah. So 9:35 is when we again start with the second part of the session. Yes. So I hope everyone is back. As discussed, 9:35, we are starting. All right. So the next thing that we need to learn are financial intermediaries. Okay. So firstly, let's understand financial intermediaries in the organized sector. They are money lenders or indigenous bankers. So like I said, zamindars or sahukars. Then there are pawnbrokers. Pawnbrokers also have an organized manner, but pawnbrokers are agents to whom you pawn your jewelry, hmm, and then you get money. Now, this has also found space in the organized sector. Let's say you have Muthoot Finance or Manappuram Gold or other kind of pawnbroking agencies which are now registered under the government. Okay, so pawnbrokers, they can be in the unorganized sector, or they can be in the organized sector as well. And then you have unorganized traders and landlords, the zamindars, the saukars, all these are your intermediaries in the unorganized sector. Now let us come to the organized sector intermediaries. So you have again two kinds of intermediaries. Basically, what are intermediaries? Intermediaries are people or entities who help you to navigate through the entire financial system. As an individual or a retail investor, maybe you don't have access or the depth and the width to participate in the market. So you can do so through these financial intermediaries. So you have capital market intermediaries, wherein you have first what are development banks. Now, development banks, we have two major development banks, and those are called as NABARD. They are SIDBI. These are a few developmental banks which give financing to developmental projects. Okay. Then you have developmental banks such as IFCI. We are going to learn that in the next slide. Or other kind of intermediaries where they are giving money as loans for development of the overall economy, and they give loans in the long term. Then you have insurance companies. Insurance companies are companies which are LIC, GIC, and other private companies in the insurance sector. So they provide insurance facilities for life as well as for general insurance. So they have insurance facilities for life as well as other assets and properties. Life comes under life insurance separately, and other assets and properties together are called as general insurance. Then you have institutions such as the UTI. Now, the UTI has changed a lot of forms. So, UTI, or I will add to it, not just UTI, but I will add to it all sorts of mutual fund companies or your asset management companies. So, mutual fund or asset management companies are those companies which are allowed and permitted to run mutual fund schemes for people. The next you have are agricultural finance companies, which wholly and solely finance agriculture only. Then you have the government, wherein you have the Provident Fund, the NSC, the NPS, which are these government institutions where people's provident funds and retirement benefits are maintained. Then you have the IRBI, the Industrial Reconstruction Bank of India. The IRBI, what it does is that it provides help, financial assistance, technical assistance, and management assistance to companies that are ailing. Ailing means to companies who are very close, okay, very close to closing down. So they all get technical and financial assistance to raise them up. Then you have the Exim Bank. Exim Bank has been specifically developed to promote import and export trade in India. So there you have international, if you are in international trade, so your bill discounting can be in Exim Bank. There are factoring and forfeiting services that are provided by the Exim Bank. The Exim Bank also gives you financial guarantees. So this all work the Exim Bank does. Then you have the NBFCs, which are non-banking finance companies. Now, they are what we commonly call as financial institutions. Now, they are not actually banks because a savings account or a current account cannot be opened in these financial institutions. What they can do is that they can loan money and they can take money as investment and loan money to people or organizations. In that also, you have hire purchase companies. Hire purchase is an agreement that you firstly, when you want to buy any asset, but you don't have the money for that, so what you do is you hire purchase it. So one by one, you pay installments until the time the entire amount of money has been repaid. The asset is considered to be hired from the agency. And once your installments are over, the property or the asset comes under your ownership. So there are several agencies which are providing hire purchase agreements. Then there are leasing companies also. So leasing companies are those companies which buy assets on their own first and they give it out on rent. It can be either in the form of a short-term rent or it can be in the form of a long-term rent also. Then there are investment companies like your typical venture capital funds, private equity funds, who are looking into investment in a business. And then there are other finance companies who give loans to people. So people who don't have access maybe to banks or people where banks is not a preferable option, they can take loan from these finance companies. So these are your capital market intermediaries. Then again, you have money market intermediaries, the largest money market intermediary being the RBI. Because if we saw that the treasury bill market is entirely controlled by RBI, the government securities market is entirely held by the RBI because RBI is working for the government as the banker of the government and the banker to the government also. Then you have commercial and cooperative banks. So commercial banks are hugely involved in money market transactions, either for their own selves or for their clients as well. Then you have post offices and savings banks. You have small banks like, for example, you have a small bank like Bandhan Bank now is a very big bank, but earlier you had a few NBFCs which was to be called as small business banks. Okay, so those are there, and of course the government also plays a huge role in money market transactions. Also, government plays a huge role in foreign exchange transactions as well. Okay, so all these are your financial intermediaries. All right, now let us understand a few structures of the financial regulators or the structure of an Indian financial system. So there are two main regulators in the Indian financial system. One is the RBI and the other is the SEBI. Now, what all comes under RBI's purview and what all comes under SEBI, that we are going to discuss. So, I would say that two major pillars of the Indian financial system are the RBI and is the SEBI. Now, let us understand what all comes under the control of the RBI. So, firstly, all kinds of commercial banks come under the purview of RBI. So all commercial banks. Now there are also different kinds of banks that we are going to see, but all kinds of banks. Even if you are a bank which has been started in India or abroad, whenever you have to come to India, you will be controlled by the RBI. The next are your financial institutions. Now, financial institutions, you have several financial institutions. Let's see them one by one. The first kind of financial institution are institutions which provide term financing. There are several kind of institutions which provide term financing. Now, the first institution that I'm going to talk about has been completely dissolved and it has been converted into a full-fledged commercial bank, which is one of the largest leading commercial banks of the country. So the first one of them is Industrial Credit and Investment Corporation of India. Okay, that is ICICI. It has been merged and demerged and merged to become a full-fledged commercial bank. Also, you have organizations such as IDBI, which also has been converted into a leading commercial bank. One institution which still continues to remain its hold is the IFCI, which is the Industrial Finance Corporation of India. Now, the Industrial Finance Corporation of India gives large amount loans to large scale public and private sector organizations. Okay. So IFCI basically was the dream child of Jawaharlal Nehru, and he said that big businesses, big factories, big industries should be started, and therefore there must be some government agency which will provide loans to that. So the original purpose still remains the same. Next, you have uh, the sectoral finance companies. Now, there you have the Exim Bank of India, which provide finance for import and exports. Then you have Tourism Finance Corporation of India, which provides loans and other facilities to the tourist sector in specific. Then you have the Power Finance Corporation. Earlier, it was a 100% public sector company. Now it has been divested, and Rural Electrification Corporation has been merged into the Power Finance Corporation of India. So it helps in electrification, providing finance to power projects, and increasing the execution of power projects in India. Of course, you have the Apex Bank for Agricultural and Rural Development, that is called as the NABARD. Earlier, the NABARD was a full part of the RBI. The RBI separated the agricultural and rural development part into a proper organization which is called as the National Bank for Agriculture and Rural Development. So this is your sectoral finances. Okay. Then you have investment corporations. Which one of them is the LIC? Now, however, the share price of LIC may be fluctuating, going up, coming down, LIC continues to remain the largest investment company in the country. There are so many people who have LIC policies. There are so many people who pay premium to LIC. So LIC also provides insurance to the people who are paying premium, but then still there is loads and loads and amount of money which lies with the LIC, and LIC invests this. Along with LIC, you have GIC as well. So the GIC is the General Insurance Company, and it also is a leader in providing reinsurance as well. Of course, the UTI is there, and then you have state level corporations like the State Finance Corporation, the SIDBI, etc. Yes, so you have state industrial development corporations, you have state finance corporations, which provide money to a smaller scale of businesses, your small scale units, for loans and financial purposes. Okay, those. So the state financial corporations are more accessible. Yes. Then you have primary dealers. RBI alone cannot go into a market, right? Alone cannot go into the market and sell their securities. So what RBI has done, it has developed a network of primary dealers. Now, primary dealers are firms, individuals, or organizations who are allowed to sell government securities and treasury bills on behalf of the government. So the government assigns this responsibility to the RBI. The RBI assigns these responsibilities to registered primary dealers who are at the bottom of the pyramid, and they have access to the public if the public wants. Nowadays, there is this facility available that you can buy government securities online. So the RBI has provided a website where you can buy government securities directly without the help of a primary dealer. But then, of course, a primary dealer also provides you with investment advice. So they can actually be able to tell you which kind of government security that you need to buy and which you don't need to buy. Yes. So primary dealers is one intermediary, the one-stop dealer for instruments that are issued by the RBI. Of course, no Tom, Dick, and Harry can become a primary dealer. For primary dealer, you need to show that you have some net worth, your firm has some net worth, and you have to pass an exam and you have to obtain a registration, and then only you can become a primary dealer. Then you have your non-banking finance companies, which also come under the purview of the RBI. The way I told in the previous slide, that you have hire purchase, investment companies, leasing companies, and other kinds of non-banking finance companies, your pawn shops, your Muthoot Finance, your Manappuram Gold, they also come under the purview of the RBI. So RBI, what it is doing is that it is channelizing or it is controlling the agencies, the institutions which are giving money and taking money. Are you understanding this? So, giving a bulk of money as loan and taking a bulk of money as investments. All these institutions are in this category, which are controlled by the RBI. Okay, I hope this is clear. Yes. I hope it's clear. All right, sure. Let's go ahead. Now, the next financial regulator is the SEBI, the Securities Exchange Board of India. Now, I don't say that this has relevance to financial analytics, but if you are going to operate in the financial system, you must be aware of all these parts. Yes. So SEBI is a very new kind of a entity. I would call Reserve Bank of India as an old person, because Reserve Bank of India was started in the year 1934. Yes, even before independence. But SEBI is a millennial. Okay. So SEBI is a millennial who is born in the year 1992. Earlier, there were all kinds of legislations which tried to control the capital markets in India, but they were almost all of them were very unsuccessful. So there was something called as the controller of capital issues, which was like a tiger who does not have any teeth. So कितना भी वो चिल्लाए, दहाड़ लगाए, it was not happening, and there were large stock market scams that was happening. Actually, to be very honest, I would give the credit of the starting of SEBI to Harshad Mehta, because if Harshad Mehta would not have done the scam, SEBI would not have been born. So I don't say Harshad Mehta started SEBI, but yes, the Harshad Mehta scam, the magnitude and the scale of the scam was so huge that it led to the government rethinking that are we providing a good regulator or not. So in the stocks of SEBI were going on, but SEBI came in the year 1992. But then SEBI right now is the I would say the most powerful entity in the Indian capital markets. Now, SEBI controls the entire capital market. So, right from your stock exchanges to your stockbrokers, the participants, the in the stock exchange market, the intermediaries, financial services, merchant bankers. Then there are entities which are called as underwriters, custodians. Every company, if it has to go for an IPO, an FPO, a bonus share, a rights issue, a stock split, or maybe a stock merge, has to take the permission of SEBI. If SEBI permits, they can do that action. If SEBI does not permit, that action is not allowed. So corporations are being controlled, companies are being controlled by the SEBI when it comes to capital market transactions. Then the intermediaries are also controlled by SEBI who are playing in the capital markets. The financial services that are being provided in the capital markets are also being controlled by SEBI. The mutual funds which play in the capital market will be controlled by SEBI. The venture capital funds which want to invest in the business and later on after the business ripens and matures and take out the money from the business are also being controlled by the SEBI. So if you want to aspire to become a stockbroker, you have to get a SEBI license. If you are a merchant banking company, you have to get a SEBI license. If you are an angel investor but would you like to get yourself registered, you have to go to the SEBI. So anything and everything that is related with raising money by large corporations is being controlled by SEBI. So companies' actions are being controlled by SEBI. Stock exchanges are being controlled by SEBI. Any high or low or any suspicious pattern in the stock market follows an inquiry. Okay, so your stock exchanges, its accounts, its transparency, its fairness, all is being looked by SEBI almost every minute of the trading day. So Monday or to Friday, SEBI is having a watch over your stock exchanges and all the intermediaries that are involved in the capital market. So the regulators RBI and SEBI, now both these regulators are large contributors to ensure that finally the final aim of investor protection is being fulfilled. So why are these people working and keeping a hawk's eye on all these kinds of businesses? Is that the normal average investor or the participant of the financial system like you and me get full access to all kinds of financial services available, and also to get full access and also to protect our interest so that our hard earned money is not lost somewhere. Okay, so these are your financial regulators. So these financial regulators perform all these functions. Moving on to the next slide, we will understand what exactly is the banking industry looking like. So I think most of you have a fair idea of what a bank is. Many of you are coming from the banking and finance domain. So let's quickly go through this. The Indian banking system again consists of two parts: the organized system and the unorganized system. Unorganized system, I think we have had a reasonable discussion on that. So let's talk about organized banking system. There you have commercial banks. So banks who are allowed and who are empowered to carry on all the banking functions. Let's do a quick brainstorming of what all different banking functions can be there. So when I say that I go to, let's say, Axis Bank or maybe State Bank of India, yes, what kind of banking functions can be there? I will start off with opening a savings account or a current account. What other banking functions are there? You can also reply on chat. Yes, FDs. Okay.
Locker services.
Pardon me.
Locker services.
Locker services. Good. How about recurring accounts? Loans. Good. Other investments. Banks have tie-ups with capital market entities.
Yes,
So they
mutual
can help
funds,
you
right?
make, correct? So they can help you make capital market transactions. What else?
Demat account services.
Demat
Digital
account processes. Yes. They can
digital
provide
gold
insurance. Yes, sorry.
digital gold services.
Digital gold services. Yes. So they are participants and entities who sell sovereign gold bonds as well. What else? Credit. Yes. So you can have all kinds of credit facilities. You can have a cash credit, an overdraft, a short-term loan, a long-term loan. Banks can also provide you help get a bank guarantee, a financial guarantee where a bank vets that you are a creditable person. So they give you electronic transfer payments. Yes. IMPS, NEFT. To add to that, I would also add RTGS facilities. So money transfer payments. A bank gives you access for foreign exchange operations as well. They can operate through the SWIFT network, help you procure and acquire foreign exchange. Yes. So all these and much more is provided by a proper commercial bank. They can also have help you for obtaining letters of credit. Hmm? Banks help you to find out your credit worthiness these days as well. Hmm? You have locker facilities, as rightly mentioned before, where you can safe keep your valuables or valuable papers. Then they can help you plan your finances. A bank may provide you with wealth management services, with portfolio management services through their relationship managers and wealth managers as well. So bank is not only limited to opening accounts, but also it ranges through all kinds of such facilities, right? Now, when it comes to banks, we have two kinds of banks. One are the public sector banks and the others are the private sector banks. So the largest public sector bank in India now becomes SBI. All the associates of SBI have been successfully merged with SBI, and SBI now continues to become only State Bank of India. There used to be a few affiliates of State Bank of India, let's say State Bank of Bikaner and Jaipur, State Bank of Hyderabad, State Bank of Mysore, State Bank of Punjab, and also there used to be 7 intermediaries of SBI. Now they have been merged. There is this whole new wave where major public sector banks were merged with each other. So Vijaya Bank, Dena Bank went into Bank of Baroda. Syndicate Bank went into Syndicate Bank went into Canara Bank. So there has been a consolidation in the public sector banks to make a few chunk of public sector banks in India. The reason is that most of the public sector banks, due to less customer satisfaction, used to be more and more inefficient. So the government did not want that there are so many public sector banks, and that they have, and the private banks were growing larger and larger. So there has been a consolidation in the public sector banks, and now we have a limited number of public sector banks that are available. Next, we have the private sector banks, wherein we do have banks which have been registered and started in India. But also, due to liberalization, we have banks that have been registered and started in other countries, but do have branches in India as well. So those also have to get registered as per the Banking Regulation Act. Okay. So we have foreign banks, we have private Indian banks such as now HDFC Bank, ICICI Bank, the this what do you say, IndusInd Bank, and other kinds of banks. IDFC Bank is there, IDBI Bank is there. So these are private Indian banks. The leaders in them, of course, are HDFC Bank and ICICI Bank. Others are relatively smaller. We also have Axis Bank, yes, and the others are foreign banks. So banks which are actually that were started somewhere else, but also do have their banking business in India. So you have the Citibank, you have the Standard Chartered Bank, you have Deutsche Bank, you have HSBC. So all these are your foreign banks that are operating in India. The next category of banks are regional rural banks, which come under the purview of NABARD. Okay, so regional rural banks operate at a rural level, and they cater to small term banking operations which are specifically meant for rural areas. So you won't find an RRB in an urban area, but you will definitely find a regional rural bank in the remotest of the parts where commercial banks don't find it feasible to start branches. Of course, under the Banking Regulation Act, commercial banks are made to have rural branches, but in remotely accessible areas, it does not become feasible or profitable for a commercial bank to start a branch. That is the reason why some regional rural banks have been formed, which are small banks which are government controlled, okay, partially government controlled, and they can get access to the most remotest place in India due to their small nature. Because they are small, they are flexible. The next are cooperative banks, which are formed as cooperative organizations. Commercial banks are registered under the Companies Act, whereas the cooperative banks are registered under the Cooperative Societies Act. So banks such as Cosmos Cooperative Bank, Saraswat Cooperative Bank, TJSP Cooperative Bank, Janta Sahakari Bank are cooperative banks whose basic structure of ownership is of member being holder come owner of the business. Commercial bank just provides you services. Owners can be different, members can be different. Cooperative bank, members are owners themselves. They have to become a shareholder of the company, and the scale of a generally cooperative bank is smaller. But then again, it depends upon your choice which banking facilities that you can have through cooperative banks. And then of course you have developmental banks like NABARD, yes, where NABARD helps you to raise finances. As an organization or as an individual, you cannot directly go to the NABARD. NABARD is a refinancing kind of organization. Now, every bank has to lend to certain classes of customers, which is called as priority sector lending. Now, when the bank lends to priority sector, it is losing out on profit. So, a bank like NABARD, a developmental bank, refinances the loans that the bank has given to the priority sector so that the bank also runs on profit. So, this is the major role of NABARD. is to refinance banks, financial institutions, crop agricultural credit cooperative societies, then agricultural lending institutions, so that those institutions will provide loans at accessible and low rates, and then they will get refinanced by the NABARD. So as an individual, I cannot have an account in NABARD. So these are the key players in the banking industry. Now, there is also an industry which is called as an insurance company. So the insurance company or the insurance industry in general is being regulated by another regulator, which is called as the IRDAI, Insurance Regulatory and Developmental Authority of India. In India, due to opening up of the insurance markets, we have public sector insurance companies and private sector insurance companies. Okay, so the number in brackets tells you about the number of players in each part. Now, insurance as such can be divided into two categories. One is life insurance, the other is general insurance. In life insurance, you are insuring lives. In general insurance, you're insuring health, property, and any damages or destruction of property. So in the public sector, here also, there are a few companies which are government owned and which are privately owned. So in the public sector also, LIC is only one public sector life insurance company. In general insurance, you have six, let's say United India Insurance, New India Insurance, and other kind of insurance companies. So in public sector, you have LIC of India, and you have other six general insurance companies. In the private sector, so private entity held insurance, in the life insurance domain, you have somewhere around 23 insurance companies which provide life insurance. You can go at Acco Policy Bazaar and you can find the list of these insurers. Policy Bazaar is not an insurance company, but it is an insurance agent. It is a large scale insurance agent which provides you insurance policies of various companies. And in the general insurance domain, in the private sector, you have around about 28 general insurance companies. Now this number changes because there are several new companies that have been added, several merged. Okay, so as of recent times, these are the number of insurance companies in India. The operations of all these insurance companies are being controlled by the IRDAI. So they have set and standard rules. So more or less, the premiums, the rules and regulations of insurance companies is more or less the same. What differentiates them is the customer service that they provide. So you can't take the amount of premiums that you are collecting depends upon the rules of IRDI. So more or less the rules and regulations for collecting premium and paying off the insured amount remains the same. What matters and what differs is how accessible that insurance company is and how easy and what kind of plans they offer. Of course, they are also more or less in the same category because IRDAI has provided a rigid structure beyond which no insurance company can move. Okay, so these are the key players in your insurance companies. Then a few different type of insurances that we must know, because though I see that there is a financial analytics course being conducted, but if you are employed for a client who is an insurance company, then you must know as a financial analyst what are the different types of insurance. So the first kind of insurance is your whole life insurance or a simple term insurance, where the insure you keep paying insurance premium till you die. Once you die, your heirs or your registered kin will get the compensation. Okay, the simplest term or the simplest form of insurance. The next kind of insurance is endowment insurance, where either death or expiry of policy, whichever is earlier happens, you get compensation. Then you have annuity plans or retirement plans. So you keep making some payment either up to your death or up to your retirement, and thereafter you are going to get regular sum of money either in lump sum or on a monthly basis. There are some plans which have with or without profit. So if the insurance company makes a profit, they will share it with you. Then there are joint life policies, where it is a umbrella policy where two or more persons are there. There is group insurance, let's say a corporate group insurance where your entire employee spectrum is insured. You have a key man insurance where the key person of the organization is insured. If due to death, resignation, retirement, or repulsion of that key man, there is some loss of work which is quantified and compensation has been paid. And then there are market linked policies where a certain part of the life insurance policy ensures the life of the individual, but also a chunk of it is invested in market instruments. So you can get benefit of like a mutual fund as well as insurance at the same time. Now, when we talk about general insurance, there are several such things such as fire insurance. The most common is fire insurance for organizations. Now, fire insurance doesn't mean only fire, but it can also include other kind of perils as well. Yes, so there are perils such as fire, then there is a peril such as an earthquake, a volcano, a tsunami, a flood. All kinds of perils can be included in fire insurance. A missile attack. These days you have to be very sure, yes? So a missile attack, a war, or any other kind of a peril. Sometimes it can also include theft and pilferage and damage to property as well. So fire insurance is a comprehensive term that is given to insurance policies which cover your property from fire and other perils. Then you have marine insurance. One is a voyage insurance where the goods that are going through water transport are insured. And there is a hull insurance where the ship itself is being insured. Then next you have accident insurance. So accidents don't happen, I mean, they happen suddenly, and sometimes there is loss of life, there can be death, there can be physical injury, there can be partial physical injury, there can be deliberation due to injury, you can be made unworkable due to injury. So it protects you from any kind of accidents. It gives you monetary benefit for loss of work due to any accident. The next is the health insurance, which is particularly relevant in today's time. Everyone must have health insurance. I hope everyone in this session today does have health insurance. Prevents you from, gives you protection, financial protection for hospitalization, any kind of hospitalization, pre and post hospitalization expenses. You have then travel insurance, which ensures your transits, your travels. Most preferable for having travel insurance for foreign journeys. Also, even if you book an IRCTC with rupees 1, you can have an insurance for your train journey as well. So it includes any loss that has happened due to travel, any theft, if your luggage, your money, your passport, your tickets, etc. are lost, or damage, and the financial burden that you have to pay is included in travel insurance. Then you have motor insurance, which is for two-wheelers, three-wheelers, four-wheelers, six-wheelers, trucks, etc., all kinds of vehicles. It has two parts. One is if something happens to the vehicle, part A. Part B is third party damage. Third party damage is when, because of your car, there is loss to someone else, or it leads to loss of life of the person involved in an accident, other person involved in an accident, then you are eligible to get compensation. That person is eligible to get compensation for third party. In India, it is compulsory to have at least third party insurance, even if you do not want to have other parts of insurance. It is compulsory to have third party insurance as well. Then for banks, there is a credit insurance which is provided by the RBI. So every scheduled bank provides is being provided with a credit insurance, that if a bank is suffering due to non-payment of bank loan, the RBI intervenes and protects these bank loans. Then you have other property kind of insurance. Also, you have something which is not included here, which is crop insurance. So agricultural sector is being developed, is being safeguarded by the crop insurance. The next is workmen compensation, which is an insurance for workmen which have suffered injuries, any loss of limb or death when they are working in a factory environment. Factory is a very risky environment as compared to the service sector. So any loss of life, any loss of limb, any kind of physical handicap or ness that comes due to working in a factory is covered under workmen's compensation, right? So these are the types of insurance that we can have. Now in tomorrow's session, we will be tackling with in mutual funds, hedge funds, and other parts of the financial system. Okay, so I think we will close the session here. As we are being recorded, I would just like to take a quick feedback if the session was satisfactory or not. So I hope the session was satisfactory and the points explained were clear. Okay. Yes. All right. So thank you, everyone. And we will meet tomorrow again at 8 o'clock sharp. Okay. Yes. Thank you. Thanks a lot, everyone. So I think we can end the meeting. Okay, for the materials, you can go through the PPT. I think the representatives at coachX will, I guess they do have a facility of providing the recordings of this lecture. I think, I'm not sure, but you can ask them. I think the recordings are going to be provided. So you can go through the PPT and you can go through the recording. Yes. Okay. So I think we'll, apart from PPT, if possible, I'll be trying to provide you notes. Let's see. I have to ask the representatives of coaches. All right. Yes. So I think we can end the meeting now.